Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's video, I am going to talk about 3 chemical companies for which EVs could be a huge catalyst. The electrification of vehicles is not just a narrative anymore, but a mega trend that is taking over fast. This transition has been made possible by multiple factors, the biggest of which is the decline in the battery costs. On the top of it, factors such as policy tailwinds, PLI schemes, carbon footprint commitments, subsidies, and the investment in EVs by corporates have come together to put this transition on accelerator. As EVs take over ICEs or internal combustion engine based vehicles, it is going to be a gold rush out there. You see, at 1 crore, the global EV penetration is well below 1%. As per IEA, by 2030, EVs could grow 15 times at 30% CAGR over the next decade. Now, I'm sure you're familiar with the companies in both the listed and unlisted space that have got into the production of EVs. I'm not going to talk about these obvious plays that you have already read about. I'm more interested in the pick and shovel plays, in other words, the EV supply ecosystem. As per World Economic Forum and McKinsey, the battery demand in 2030 for EV energy storage and consumer electronics is estimated at over 2600 gigawatt hours, with EV chain providing revenue possibility of 300 billion US dollar. Almost a dozen companies are planning to set up EV battery manufacturing plants in India over the next few years, in line with the government push to make India a significant global manufacturer of EV vehicles. After inviting global bids for Giga Scale Advanced Chemistry Cell or ACC production units, the Government of India has selected 4 bidders from 10 for allotment of 50 gigawatt hours of battery capacity, which include Reliance New Energy, Ola Electric, Rajesh Exports, and Hyundai Global Motors Company Limited. They will receive incentives to boost local battery cell production. The battery manufacturers would have to set up ACC capacities under PLI scheme within a period of 2 years. This is expected to lead to direct investment of around rupees 450 billion in ACC battery storage manufacturing projects. As such, a great window of opportunity has been opened for the chemical companies that are going to be a part of EV battery supply chain. Early movers on this opportunity could find themselves in a very sweet spot in the years to come. So, coming to the names, the first in the list is Balaji Amines, a specialty chemical company. This company is a well known market leader in the production of aliphatic amines that find use in pharma, agrochem, dyes, and paints industry. In a recent capex plan, Balaji Amines has added another chemical to its basket that will help it foray into the electric vehicle segment. In September 2022, it has started producing DMC chemical or dimethyl carbonate with installed capacity of 15,000 metric ton per annum. DMC is used as an electrolyte in lithium ion batteries, and besides, it is used in manufacturing polycarbonate, a lightweight, high strength polymer that finds use in contact lenses, medical devices, automotive components, and electronic devices. Do note that the company will be the sole producer of this chemical in India. So far, the domestic demand stands at around 8,000 tons per annum, has been met through imports. With the rise in electric mobility, this demand is expected to rise as well. Besides, the product will also be used for exports. As per the management, at peak capacity utilization, DMC plant has the potential to generate revenue up to rupees 4 billion. This is 17% of FY22 revenue and offers the company a great way to enter the EV space without being overtly dependent on it. Balaji Amines fundamentals look strong with FY22 operating profit margin at 28%. Its debt to equity is minimal at 0.08 times. The ROE is 34% and ROCE is 50%. The stock is available at a P of 22.4 times and has corrected 40% from the peak in 2021. The second stock on the list is Gujarat Fluorochemicals. The company is a part of Inox Group and is a leading chemicals company with a niche in fluorine chemistry. Its products find applications in pharma, food, aerospace and defense, telecom, electronics, semiconductor, cookware, paints, and so on. Along with fluoropolymers, it deals in refrigerants, specialty, and bulk chemicals. It is a major producer of chloroform. It claims to be the sole manufacturer of PTFE or fluoropolymer. Further, it is the largest producer and exporter of R22, which is a feedstock for refrigerant gas. More importantly, it is developing products in chemical grades that are catering to new age businesses such as EV batteries, solar panels, and hydrogen fuel cells. One such category of products is PVDF polymer, which is widely used as binder in lithium-ion batteries. It can be injected, molded, or welded and is commonly used in the chemicals, semiconductor, medical, and defense industries along with the lithium-ion batteries. Further, the company is in the process of setting up an integrated battery chemicals complex. In FY22, the company enjoyed an operating profit margin of 34% and return on capital employed and return on equity of 20% each. Its debt to equity ratio stands at 0.35 times. The stock is available at 32 times PE and is down 26% from the peak in the last 3 months. The third chemical company that could ride the EV trend is Neogen Chemicals. Neogen is a leading manufacturer of bromine and lithium based specialty chemicals with customers across multiple industries, including pharma, engineering, battery chemicals, and agrochem. Almost 50% of the revenues come from export markets. The company is backed by technocrat promoters. Neogen has planned new initiatives in the lithium battery sector. It is developing a portfolio of battery application products that include electrolyte formulations, electrolyte lithium salts, specialized cathode materials, and other advanced intermediates. A lot of these products are at quality and efficiency optimization stage and have the potential for commercial scale up. The company is having discussions with over 15 potential cell manufacturers across the world that are interested in these electrolyte and electrolyte salts. Coming to the fundamentals, the return on equity and capital employed stand at 14% for the company in FY22. Its debt to equity is 0.6 times. The operating profit margin is at 17%. The stock is trading at a PE of 65 times after 37% correction from the peak. So these were the three chemical companies that stand to benefit from the electrification of vehicles. Do keep in mind that these are not stock recommendations, but businesses to be kept in your watch list that could benefit from the rise of EVs. Do not forget to press the like button if you found the video interesting and do share your feedback in the comment section. For more such video alerts in future, please subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.